Hey everybody, welcome to the No Shill Zone with Ben Cowen and myself. It is as always awesome to be back on this Monday 11 a.m. Here we are, and I thank Ben for joining us. He's actually on vacation, so that's real dedication there, folks, to be away with the family and say, hey, listen, I gotta go do my technical analysis and my data feed and everything because people that rely on this, and I understand that. And the feedback we've gotten from this show, Ben, is just been remarkable, and it makes me happy to see us helping people. It's pretty cool stuff. So how are you?
Yeah, pretty good. Just on vacation. Of course, vacation with four little kids is a different type of vacation than other vacations, but it's been great. And yeah, the markets never sleep, so it's hard to take a week off. So thanks for taking the time out of your day as well, Gareth, to do this every Monday.
I love it. I love seeing the comments. The positivity. It's over the weekend. I was making some comments about how there's always the negativity on social media because people want to take you down. But I think people that want to succeed in life, they focus on the positive and they understand that even if you're helping just one person get through this and understand things that they might not have otherwise, you're doing a really good thing for people. So
Mhm.
very cool. And with no further delay, I think we get right into the action here. And we could start with crypto a little bit, I think. Just
Sure.
talking about what's going on. I mean, we were just commenting how, the crypto market has gone to sleep, which has happened in the history of Bitcoin and the cycles. And pretty much, I think, Ben, correct me if I'm wrong, but almost every cycle during the bear market, you have periods like this where it just kind of goes to sleep.
Right. Exactly. Yeah. And basically nothing happens, and then one day, at some point, it could be 4 weeks from now, it could be 8 weeks from now. No one knows. We probably get a massive move in one direction or another.
Now we were just talking like it almost looks like a little bit of a bull flag, and we were kind of talking about how this pattern of sleepiness is slightly fading down, and oftentimes in technical analysis, doesn't matter if it's charts or crypto of stocks or whatever it may be, this oftentimes can lead to a pop. But you were saying, and you brought up a good point, that in 2019 this kind of happened, but it didn't lead to a pop.
Yeah, so if you can see my screen here, there's actually some, and actually, you know what, Gareth? What's interesting, it's not just 2019, it's every Q3 of every pre-halving year this happens, where you get this slow fade back to the 20-week SMA, the 21-week EMA. This is 2019 over here. You can kind of see how it was slowly fading. And I mean, look at these weekly candles back over here. It was barely moving. And then what happened is we woke up one morning and Bitcoin just dropped 20%, and the altcoin market basically had the life sucked out of it. Now, what also is interesting though is it was on this weekly candle right there that a lot of altcoins bottomed against on their Bitcoin pairs. They kept going down on their USD pairs, but actually several of them bottomed on their Bitcoin pairs once Bitcoin saw that like 20% drop. Now, imagine what would happen today if Bitcoin saw some type of like a 20% drop. A lot of altcoins would likely capitulate. But just to sort of cover our bases here, look at Q3 of 2015 fading
Mhm.
into that 20-week SMA, and we got a capitulation down. And then finally, 2011 Q3, right? That slow fade down into the 20-week SMA, and then you sort of kick off the rest of the downtrend. And then it was in the halving year where things tend to pick back up.
Yeah, an interesting little note here on that too is that it often seems like my guess is you have a lot of investors that may be leveraging for a move up, and then when that breaks, it either stops them out by hitting their exit, or they just naturally are saying, "Oh my goodness, look at this exit," and so let's all. And if you have a thinner market, and I think we can agree, Ben, is that the volume right now in crypto is pretty anemic. It is, and so if you get even a decent amount of people to exit at the same time, it probably has an outsized impact on price.
Yeah, exactly. And I mean, I also think the issue is that these are very illiquid markets,
Yeah.
so it doesn't take a whole lot to move an altcoin in any direction. I mean, any buying pressure at all, any selling pressure at all can move the altcoin market 10-20%. But the issue is that it's just been a slow bleed for what, almost 2 years now. One thing that's interesting, the further we get into this, it seems like the less hopeful people are that it'll ever end, right?
Yeah.
I think it's important for us to all remember that, within probably, I would say, the next 6 to 9 months, there's a good chance that the altcoin market could actually turn back around in it's more of a macro move, right? Because you were talking a few weeks ago potentially about some of these short-term bounces on the altcoin market on the way down. And I think maybe we should talk about that. But do you think there could be a macro move in the other direction sometime within the next year or so?
I do, and I think there's a lot of. I really do believe that there's a fair amount of value in a few of the altcoins. You know, whether it's I don't know if it's Polygon, I don't know if it's Solana or Cardano or Polkadot, but I do think that if you start putting them in a security, even if they're put in the okay, these are securities, then you have to start reevaluating them based on okay, well, what's their value in that structure? Do they create earnings, or how many networks are or things are built on that specific network? And I think that's where you start to come up with saying, okay, well, if we just get a little bit more clarity from the SEC, you could actually see some decent ability to value. And I think that's been one of the major issues that I've had is that there's no transparency for a lot of this stuff. And
Mhm.
so I find it very hard as a stock person or a commodity person to say, okay, this is what it should be trading. We've got to give it a multiple. What's the multiple? Because in the stock world, it's okay. You know, Apple is this type of stock, so it gets a multiple of 20 or 30 based on earnings. For altcoins, you can't really do that, but there's got to be some metric we can use. And I do think that there is some value here that will be unlocked, but clarity again is key.
You know, you think back to the dot-com crash, which I know you lived through. It wasn't until a lot of those dot-com companies found real utility that we came out of that bear market, right?
Right. That's
Yeah.
right.
Yeah.
That's
So I guess in the short term, are there any altcoins? Because I mean, I know you trade the shorter term moves, right? Are you looking at any altcoins like short on some shorter term timeframes right now?
Yeah, at least on the daily chart. So one of them, and again, it still has a little bit of a dump. And if we get that Bitcoin flush to let's say 27,000 that I've been talking about, maybe that's going to be a major trend line. I kind of am eyeing Cardano. Now Cardano right now is putting in a bear flag, which is fine by me because I'm not long Cardano. But what I do like is this trend line. See this parallel here that goes down, and we broke above it here, but then broke below, then we broke back above. This trend line should be good support again, and that's right around 27 cents. So again, a quick flush into that, I'd be a buyer, not as a long-term investment yet. I'm not confident enough in that, but just as some sort of buy there. And then looking at Solana's trying to break this support here. And then see this kind of coordinated. You have this downsloping trend line from pivot to pivot, and we broke out. And then this upsloping one, look at how they're meeting right there. Now, this is still a fair way away, but 1650, I love when two lines converge because it's like one line is support. If you get two lines together, it's like double the support, and it gives you more confidence as an investor or trader. So I think those are two that I'm kind of keeping an eye on if they dump out a little bit. Lastly, I'll mention XRP because XRP is actually getting closer to this previous pivot high from the last consolidation, and it's right around 58.5 cents. And I wouldn't say go all in there. You should never go all in, but I would start to accumulate a little bit around 58 cents and then slowly buy as it comes down to some of these secondary levels. So again, the beauty of being a swing trader is that there's always something to either enter or exit. It gives you more possibility for action.
Yeah, for sure. I mean, it's interesting the shorter term timeframes. The Solana stuff. I mean, Solana has been a bit more resilient, I think, than some of the altcoins because it capitulated quite heavily at the end of last year with all the stuff that was going on with it. But I think we talked about this like on a prior week where it kind of looks like so. Here's the Solana chart, and I'm looking at this potential idea where we put in a low and put in a high, and then we swept the high. And I'm wondering if Solana is now going to sweep the low. So if it breaks down below that trend line that you're looking at, which is, I mean, it's an if-then statement. I don't know for sure if it would, but if it did break down below that trend line, then it makes me wonder does it actually go on to sweep the low? And, I know that might be seen as a fairly bearish view, but I can't help but remember last cycle when Cardano, right, it did the exact same thing, right? It basically capitulated over here. We then put in a high. We then swept the high, and then we went down. And guess what? Right? We swept the lows.
Mm-hmm.
And then it was only after Cardano swept the lows that it then took off into a more sustained run. So I'm still thinking that there is a chance that a lot of these altcoins could fade back down and sweep some of their lows, maybe take those lows out, and then maybe it could even occur as late as right before the halving. So I'm still looking for that on a more macro basis if some of those shorter term trend lines don't hold.
Interesting. Before we move on, I want to just quickly look at the Ethereum chart, just because you do see the same sort of trend line as Bitcoin has, and it's kind of interesting because all of these charts they're semi kind of connected, and we really see the connection with Bitcoin and Ethereum, where this trend line is almost identical on the Bitcoin chart, and you can see that we are same thing, kind of getting closer and closer to that level. And to be honest, so I have a short out on in Verified Investing Crypto, the service, and we're in the money. We're short from up here. The concept is, do I go long at the line, or do I just cover? And I've been dealing with that myself on a trading basis. And right now, I think I would cover the short there because there is a chance of a bounce, but I'm not confident based on this chart of it not breaking down. And so I don't think I would flip it into a long. So covering a short is one thing, flipping it from being short into a long is another thing. And just a little technical analysis here is what you'll see is the more you hit a trend line, the weaker the trend line becomes. And the concept behind this is, think about a door, right? Your door to your house is locked, your cat's inside, your house is on fire, right? And you really want to break it down, or your dog's inside, whatever animal you want to put in there. You ram that door once, probably doesn't break down. You ram it twice, maybe 3 times. At some point, the force you're exuding on that door is going to make it cascade and break down. And so think about this as your doorway. And the more you hit it over and over again, eventually you hit it enough, it's going to break. And that's kind of why I'm not ready to go long Ethereum at this line. But I would say, okay, well, there's still a chance of a bounce, so I probably do cover my short.
I think there's a little bit of confluence with the way you're thinking on that, because if you look at the Ether chart on like a weekly time frame, this is the exact moment basically in 2019, right, where it stopped holding those higher lows. Right, you can draw an imaginary trend line through here and kind of see that same higher low structure, and it was basically in August, in fact, of 2019 when it broke. And then there's this other thing, and by the way, we're sort of coming into that same area right here. There's this other idea that we've looked at before as well, and that's that year-to-date ROI of Ethereum. And when I look at this chart, there's a lot of years that are sort of outliers, right? Like 2018 and 2022 are all the way down there. So let's remove those. You have 2016, 2020, 2021, and 2017 all the way up there. So let's remove those. And that leaves you with these 2 year-to-date trend lines that are the most similar, right? It's 2023 and 2019. And what's interesting is you can kind of see those higher lows from that 2019 cycle that I was just talking about. And then it was around this time frame, right, when it actually started to finally break down. So I think from like a seasonality perspective, Ethereum just typically doesn't do that well in Q3, Q4. So I would suspect there is a good chance that the trend line won't actually hold, and we get sort of that secondary scare before going into a more sustained move sometime next year.
Very cool. Yeah. So flipping over, and I know we're going to do a little bit of a shorter one today to respect your vacation, and I totally am in for that. But I think just going to last week, we had the jobs data on Friday. Right. I was personally very surprised. And again, it takes a fair amount to surprise me, but the jobs data was 187,000. I think the market had anticipated 200-ish. So it was kind of like a Goldilocks number. It wasn't so weak that everyone was like, oh my goodness, we're heading into a recession, but it wasn't so strong where it's like, okay, the Fed has to continue to raise. Yet the markets on Friday, we saw this, and I'll go to that action here. This is Friday right here. We opened higher. We had a little sell-off, and then we started to float. And usually in the summer months, volume in the stock market's really quiet. And once you start the float on a Friday, especially off of good news, you just continue to float sideways to up the rest of the day. Instead, we saw a big sell-off. So I guess my question is was there something here that kind of freaked people out? Was it the yields moving? Is it the dollar? I mean, what are you thinking? Do you have any thoughts on that?
I guess my initial thought is actually, so last week we were talking, I don't know if it was last week or 2 weeks before, or week before, but we were talking about just seasonality in the S&P. So there is one idea, of course, that it's related to a larger move that could take us down much further. But there's this other idea that it could just be a seasonal factor as well. Because like when I look at the job openings, I mean, like, so this is total non-farm. We're still technically like right at the pre-pandemic trend. So like this does not yet look recessionary. I mean, I think the ultimate outcome at the end of the business cycle is likely a recession, but I don't really know that it's at a recession territory just yet, just because there's so many job openings. If you were to flip over to manufacturing jobs, I mean, it's coming down pretty quickly, right? If you were to flip over to durable goods jobs, it's coming down quite quickly. I think the reason why jobs are still being held up so high is in due large part to government job openings. Just remain so high. But we talked a little bit about this seasonality in the S&P, right? So this is the 2023 year-to-date ROI in the pre-election year. Look at 2019. I mean, this is right when we had a correction in 2019. This is right when we had a correction in 2015. Like right around this time frame. And then look at 2011, a big correction right around this time frame. 2007, a correction, right? 2003. You can look at most pre-election years and see that there's a large correction around this time, right? And so, I tend to think that there is at least some seasonality going on in this, but I think where the issue becomes is whether it goes higher. So in 2019 we had a correction, right? But then by the end of the year, the S&P was still putting in new highs. I think the ability for the S&P to put in new highs later on this year is going to be dependent on if the recession calls, if they materialize by the end of the year or early next year. And I think there is a decent likelihood that they do.
One of the things that you're pointing out on your chart that I think to me is pretty remarkable is that you could argue that if the government wasn't hiring insanely,
right,
basically everything else is shrinking really quickly. But here we have the government, which we know the U.S. debt is 32.5 trillion, is hiring left and right and every which way. And in fact, I know there's bond sales, there's literally a trillion in bond sales that between, I think, a few weeks ago and the end of the year will be going off as well. And so it's almost like you have the Federal Reserve shrinking their balance sheet, but then the government is jacking their balance sheet up to offset that. And it's just, something that people kind of should realize is that, it may not, overall, the economy may not be as strong, even though the jobs numbers are strong because of the U.S. government hiring.
Yeah. I mean, like manufacturing job openings were down 26,000. Durable goods were down 23,000, but total government were up 10,000. State and local were up 32,000. So they're sort of offsetting right now. They probably won't offset forever, but for now, it seems like they're more or less offsetting.
Interesting. And I want to show quickly, so one of the things I'm looking at here is this is the 10-year yield. And I think the big thing for me is just remembering that this high in the 10-year when we hit 4.3, that coincided with the October low. So as soon as yields put in that high, we started to get the rally that we've seen basically nonstop. This high pivot over here coincided with the banks failing, Silicon Valley Bank. And so you wonder, as you push up, does something new break, or does the stock market finally start to kind of re-accelerate back to the downside to play catch up? And the other thing to just point out is I have a longer term trend line where I think the 10-year is likely headed. We can see it right here sloping up through all of these highs, right? All of these highs, and it's right around 4.5%. So one of the things I'm trying to game out for the markets is, well, how high could the 10-year go? Because I do think the higher the 10-year goes, the more pressure there will be not only on the economy, but on the stock market as well. And it's looking to me like you might have a 4.5 handle in the not too distant future on the 10-year yield.
You know what? It's interesting because a lot of the I was looking at that too. The 10-year recently broke out, sort of back tested that trend line, and then continues that breakout. Mm-hmm. If you look at something that you can play against that, right? Like TLT. These bonds have been pushing lower, but I've been looking at this a lot, and there's this idea that a lot of times they sort of double bottom or put in a slightly lower low. So if your call on the 10-year yield printing those slightly higher numbers than where they are right now, that could actually correspond to some confluence on maybe TLT coming back down to this prior low here, potentially for a double bottom, or maybe a slightly lower low like what we got on the end of 2018. But I think the issue is that at some point these yields are going to go so high. I mean, something's going to break. I think the issue is that at some point something's going to break, and then at that point, we're right before the Fed pivots, right? That's where these bonds can be quite attractive, because they can shoot out very, very quickly.
Yeah, no, I think that's so true, and it's one of the things that I think in all past, there's always a breaking point, right, for everything, and I think that's the question is, where do yields have to go? I know Bill Ackman, he's a big hedge fund manager. He's shorting short-term bonds because he thinks those are too high, but he's thinking long-term. He's buying long-term yields or bonds. Well, he's shorting long-term because he thinks yields are going to continue up to play catch-up to the short-term, essentially. So it's just interesting to kind of look at what's now starting to form. And I'm hearing more, and this is something I've been talking about for a long time, is that I've always thought that inflation is going to remain sticky around 3%. And we're now starting to hear some of these bigger players like a Bill Ackman starting to say, yeah, this is likely what's going to happen is you'll have this inflation number come back down, but it's going to be so hard to get it back below because of all these underlying factors. And even the Fed printing and lowering rates. I mean, if you're only at 3% and the economy goes into recession, is the Fed not going to lower rates? Or what are they going to do here? And especially if things start to break, they're going to have to react and do something most likely.
Gareth, what's your reaction to, so like a year ago, a lot of people were calling for a recession. Now there's a lot of people that are saying a recession is no longer likely. But I still look at I look at an inverted yield curve and I say, well, would walking back those predictions during a period where technically you're not in a recession, but it's upon the uninversion where you typically get a recession. Do you think that people walking back the recession calls is somewhat premature? Because I mean, to me, it seems very premature to sort of walk those calls back when we haven't even entered the phase at which some of the lagging effects of interest rate hikes even hit the broader economy.
That's a huge point. I mean, again, go back 12 months and what were yields trading? Where was the Fed funds rate at that point? What, 1.5, 1.75%? And here we are at 5.25 to 5.5. So, I mean, to me, it shows how human nature is to be very much a fair weather friend, meaning like you just kind of, you let your emotion dictate. And by the way, this is one of the things that I think you do so well and that I do so well is that we stick to the data, right? So like, it's not popular right now to be bearish on the market. I mean, I can tell you that. And I know, Bitcoin moving up from 15.7 to 31 and so forth. It doesn't make us popular to say, hey guys, you got to be a little careful here, but it's sticking to the data versus, oh, the wind's blowing this way, let's jump bullish. And I think that's one of the things that people appreciate, but I think people are jumping the gun way too fast here. And again, it's like, show me the last time the Fed caused a soft landing and we're no landing at all when we had a type of interest rate hike like this. There's never a point. And again, with the lags and with what we're seeing in the economy, with the debt spiking for individuals, credit card debt over $1 trillion, 40% of income being spent on housing. I mean, to be honest, I just don't see. I'm still miffed to think that any analysts or economists out there are even saying soft landing.
Yeah, I mean, there's one indicator I was looking at recently. It's called the smooth U.S. recession probability indicator. It's not my indicator, but it's based on 4 different indicators: non-farm, which we were talking about earlier, index of industrial production, real personal income excluding transfer payments, and real manufacturing and trade sales. And if you look at it right now, like the chance that we're in a recession is only about 1.5%. But what's more interesting is the trend, right? Like it is starting to go back up. And you can see it started to go up over here, and then it came back down. Now, again, the question is does it actually go up for real this time? Like does the market actually sort of weaken up? Has that excess liquidity been taken out of the system? And I think it's ultimately only a matter of time, because I don't really see, when I look at what the Fed's accomplished in the past, their track record for achieving a soft landing is not a great one, right? It doesn't mean that it's impossible. It doesn't tend to happen, because what happens, right, is they just keep raising, they keep tightening until it's too late, right? Until something is broken and they can't just patch it up in overnight, right? And so I think that's ultimately what we're waiting to see if that happens or not. But I think it would be, and I would agree with you. I mean, I think it would be premature to sort of walk that back, especially considering that these business cycles, they can take a long time to play out. I think one issue is that a lot of, especially crypto investors, because we're so used to like all this volatility, we just want it to happen now, right? I think a lot of people just need to be cognizant of the fact that some of these cycles can just take, several quarters, if not years, to play out.
Yeah, and I think just recognizing that, and this is the same thing we're dealing with in crypto, is that everyone's like, oh, it's going to be an exact replica of the 4-year cycle, which it may be. But I always like to point out to people is that you don't necessarily have the same scenarios. For instance, the Fed in the previous 3 cycles was printing, quite a bit of money for the last few cycles, and interest rates were generally trending down. Occasionally it would pop up a little bit in early 2018. The Fed started to raise, then they quickly backtracked. But for the most part, it was easy money policy, and you don't have that here. Going to the stock market, the normal defense I hear for why this isn't a bear market anymore is that we've never had a bear market rally last as long as what we've seen here. But I would counter that and say, well, okay, that's fair, and it's a valid point. But have we ever had a period where we've had this much excess liquidity in the system, and how long does it take to dry that up? And again, so you can always counter these arguments out there, but I understand, people, this is a new potential data set where we're seeing such a massive or elongated rally off of the October lows.
Right. And you mentioned Bitcoin too, and the sort of the idea of the 4-year cycle. There is one idea, and I don't know how popular of an idea it would be, and I don't even consider myself to put a ton of weight in this idea yet. But we know there's seasonality, right, with crypto. We know that 2018, 2014, and 2022 look similar. We know that 2023, 2019, and 2015 look similar. But I'm curious, what are your thoughts if, let's suppose Bitcoin does get a post-halving rally? Do you think that this tighter monetary policy could lead us maybe still a rally, but do you think it could actually end up being a lower high?
Wow. I think that's always a possibility. I'm more curious. What's that?
That's that it's a loaded question for sure.
Yeah, really. So there's always that possibility, right, with Bitcoin that maybe the next rally is a lower high. The one thing that I would just point to that potentially says that is, let's just say this is a bullish pattern and we have one more leg up to go. For me, I would say right away that there's a major trend line here that I'd be watching, right? And you can see this upsloping one through these lows. I'm trying to get as accurate as possible. So you have this line connecting right through here, which upsloping wise connects perfectly right through here. And this goes back to that high from 2019 as well. So that would be if we did break above this 31,000 and really confirm, I think there's a chance we go as high as 45. Whether or not that then creates the next pullback is kind of like you said, it's hard for me to know. And I will say this is that I do think when crypto, assuming Bitcoin is normalized with institutions, which hopefully is starting to happen with the spot ETFs, hopefully approval, I do think that bigger money coming in is a benefit for the overall longer term. But you're right. Everyone's assuming it's going to be back to all-time highs in 6 or 12 months going into the halving. And I'm not convinced of that. I don't know about you.
Yeah, I guess I would try to I want to be more optimistic for sure, and just say new highs in 2025, just like we got them in 2021, 2017, and 2013. But there's also at least a part of me that wants to be a little bit cautious and say, it could play out in a different way. But I at least want to be open-minded, I guess, going into it.
Yeah, absolutely. Absolutely. So last thing, again, we'll kind of end it here shortly, but I do want to show Apple's chart here, guys, because for me as a technician, this pivot high right here, and there's a gap fill right there on the chart with this little area here, you're getting pretty close. And think about, by the way, and just throw this out, the amount of hundreds of billions of dollars that this drop right here has subtracted. It's almost like Federal Reserve tightening right there, right? You just get Apple to fall because it's a $3 trillion company. And we're now approaching, basically you're about 10% down on Apple. So that would be $300 billion in market cap vanishing. But there is a technical level maybe for a bounce around 175.70. And again, just to keep an eye on it. I don't think, by the way, that this is the end of the drop on Apple. I think that Apple now is facing lower revenues on a yearly basis, slowing growth. We know that people are kind of holding their iPhones for longer, which, by the way, is a signal potentially of a recession as well. But again, this is something to keep an eye on. This level, at least for a swing trade bounce, 175.60 or so, looks very interesting. And we're not that far away, about $2 away from it right now. The other thing I was just going to mention is that, Chipotle recently had bad earnings for the first time in a long time. And if we go to a monthly chart of Chipotle, it's really been a monster. But I also kind of view this as a good indicator for the economy, because Chipotle, needless to say, is one of the favorite fast-ish food type places. And if you see, we know that they've raised their prices because of inflation, their guacamole and all that stuff. But to start to see this have bad earnings and start to dump out, I also think that, watching a few of these very common, retail consumer staples, if you will, it is worth keeping an eye on in terms of maybe a recession signal.
I want to say one thing about that, and then I want to ask you one more thing to sort of wrap it up. The thing I'll say about that is I've seen one thing this business cycle, going back to basically what you were just saying, is there's been this tendency of a lot of these companies to do something to make sure their earnings are still good, right? Like Tesla has been cutting prices so that they can raise demand, right? And a lot of these companies have been passing on, higher prices to the consumer. The issue is that, you can only do that for so long before the consumer will say no,
Yep.
or they just don't care, right? Like Tesla can only lower their price so many times before they're no longer, they're no longer seeing those same margins. And so I wonder how much longer it's going to take for us to get to that point. And that, I think, is sort of the breaking point. The thing that might be good to sort of end with, and I think you would be actually much better at speaking about this than I would. And guys, if you're watching this on my channel, links to Gareth's stuff is in the description below. So make sure you go check out all his social media stuff. But Gareth, I'd like you to maybe comment on, because you lived through the .com crash, from an emotional perspective, like, how do people stick around? Like, especially when the altcoin market just keeps slowly going down, right? Like, what would be your advice to these people? And could you maybe explain just the sorts of opportunities that get set up when this sort of stuff happens?
Yeah. So the mentality and the mindset is very similar, right? If not identical, which is, we always think, and the markets tend to do this to us. They condition us to think dips are always buying opportunities. And let's not forget that I think it was 1997, Greenspan, the Federal Reserve chair at the time, called the stock market irrational exuberance. It was, there's irrational exuberance, and the market still rallied for another couple of years before it finally topped out during the .com era. But the pullbacks and the mentality is, you go through these stages, and I think we've looked at that chart of stages of kind of, you get to disbelief, you get to kind of, not caring, you get to despair, you get to all these different cycles. It's very accurate for what people go through with stocks or with crypto. And so, in terms of altcoins, I think the big thing is use case, right? Is there use case? Is it continually growing? And you have the stats on your website to show, like, I think, how much usage, or how many new different, I don't know what the term would be, but things are being built on top of these platforms. And I think you want to see continual growth even in a bear market. Focus on coins that are doing well in a bear market, that aren't memes, that aren't shit coins, that aren't like ones that have no use case, that are just being bought up because people can pump and dump them. But it's going to, whatever emerges out of this is going to be stuff that has a use case. And I honestly I don't like coins that can just be printed to infinity. Like, one of the reasons why I'm a big believer long-term in Bitcoin is that we know that there's only 21 million coins ever. And so there's a scarcity aspect in addition. And I think that's really an important point, which a lot of the other altcoins don't have. So it doesn't mean those altcoins won't survive. But again, how do you invest in something when you can continually be diluted to infinity, right?
Right.
That's an issue with Dogecoin, right? I think there's 10,000 new Doge every second or something like that. It's a little bit on the ridiculous side. So again, I understand, living through many bear and bull markets. I go through the emotional roller coasters with everyone else. I've just been through it so many times that I think you gain a thicker skin, where you kind of recognize that, oh, wait, I felt this way last time, and the time before that, and the time before that. So let me maybe be aware of how that caused me to have a mistake, and instead maybe kind of look at that as a contrarian indicator. So I think, again, people just have to be careful. I think the biggest thing, Ben, and I think you'd agree with this, is never invest money you can't afford to lose. That's a big thing that people need to understand. But yeah, I mean, it's rough out there in the altcoin market. There's no doubt about it. And by the way, there's still coins being pumped, by the way. I still see posts on Twitter about coins going up 1,000%. And that, to me, tells me that the bottom is not in yet. That cannot happen. When the bottom's in, finally, you won't see that.
Git, you said one thing that kind of reminds me of something that I keep meaning to say, but I haven't really found the right platform to say it on in the video. But it's basically just that a lot of the proof of stake platforms, like, if you're earning 4 to 5%, not in all cases, but a lot of times you're earning 4 to 5% because inflation of that token is also 4 to 5%.
Right.
So you're basically the extra that you're earning is only helping you from being diluted from what's extra being printed. So basically, by staking your crypto, it's basically just allowing you to keep pace with inflation rather than have you outperform anything. So I think some people need to just remember that.
And also remember in crypto that, something that's too good to be true is usually not something legit. And I think we saw this with Hex, and I don't, probably get a backlash from the Hex crowd out there. But I think, if something's paying you 20%, and when interest rates are 1%, or, your bank account's giving you 0.1%, just be careful. It's a signal, right? We have to use our intelligence here to kind of sniff out shady things. And I think the signals are there. It's just a lot of people don't want to believe it, right? It's much
Right.
better to live in a bubble, but then you get burned in the end.
For sure. All right. Well, should we wrap it up there?
I think we should, buddy. So Ben's going to go back and enjoy it. It looks beautiful there, man. It looks absolutely stunning. We will be back next Monday, 11 a.m. All of Ben's socials are below here if you're on YouTube, and vice versa with mine on his. So definitely come follow us, and we'll give you guys everything we have in our knowledge base next week, 11 a.m.
See you guys.